Well, good evening. Last time I stood here was last October when we presented our interim results to you. I spoke at that point about the challenges that the society and the wider retail industry was facing as the world emerged from the pandemic and faced long-term impacts of Brexit, and to compound matters, the war in Ukraine. It was difficult back in October to imagine that the situation would get any tougher. But as we ended our financial year in January of this year, the Bank of England base rate was at 3.5%, the highest level for 14 years. And we have subsequently seen 3 further rises, taking the base rate now to 4.5% as the bank attempts to get inflation under control, which at 10.1% back in March, being fuelled by food and drink inflation, has been increasing at the fastest rate since 1977. Many of us in this room will remember interest rates well in excess of 10% in the late 1970s and 1980s. But many of today's mortgage holders will not have known interest rates even close to these levels when you think that interest rates have been below 1% for over the last decade. And this is leading to a consumer base that faces an increasing strain on their finances. These increases in interest rates and subsequently higher mortgage payments, combined with the phenomenal increases in energy prices and price increases in food and drink, have led to consumers seeing their disposable income drop substantially in the last year. And as one would expect, this affects many areas of the retail industry, from the food and drink that we buy and consume every day, through to the large ticket items that we sell, such as furniture and carpets. Given the challenges that we've faced in the period under review, I hope that as we move through this evening, that members will agree that we have managed to weather the storm and produce a reasonable financial performance given the challenges that the retail industry have faced. The set of circumstances that we have seen over the last year and continue to see even now have become known as a cost of living crisis. And as a cooperative society, it was felt that we must stay true to our roots and assist our members where possible to navigate these difficult times. Our solution to this was in the last quarter of 2022 to introduce a number of measures to help members and colleagues reduce the cost of their weekly food shop. For colleagues, we introduced double discount Fridays, where colleagues and indeed pensioners of the society could save 20% on their spends in society food stores. For members, we have run various promotions since the last quarter of last year, with the most popular being the 10% off on Wednesday afternoons between 1 and 6. Due to the success of that particular promotion, we've extended this now in selected stores to all day, Monday to Friday for members. So 5 days a week, any time of the day, members can get 10% discount on their food shops. To celebrate the King's coronation, members receive 10% off in all food stores between Monday the 8th and Friday the 12th of May. And early figures suggest that that was well received by members. As of yesterday, the Society had provided savings to members through these promotions of £38,500. It is against this backdrop of the challenges in the economy and the wider industry that we present the financial accounts for the year ended the 28th of January 2023. I'll take the meeting through the results, highlighting the key areas and providing some background behind the numbers where necessary. But before I do, I think it once again to reiterate and take time to recognise the contribution of our stakeholders in being able to present a set of accounts that show, albeit small, a profit nonetheless. Stakeholder groups are numerous, but the first I wish to thank are our colleagues. Every colleague has played a part in the year's performance, and it's fair to say that to be able to have weathered the storm, as well as we have, in my opinion, that we've had to ask more from our colleagues in terms of the standards that they deliver on a day-to-day basis in our food stores, department stores, travel agents or funeral homes, and not forgetting the support functions in the offices and our customer furniture warehouse. Without our colleagues, we could not deliver the service to our members and customers. Another group of very important people for the society is our invested members that have also continued to be extremely understanding as we continue to be forced, due to the ongoing impact of the pandemic on cash flow, to invoke the society's rules to prevent an outflow of share capital. The loyalty and understanding of these members are much appreciated, and their continued investment is valued as always. It is pleasing that during the year we've been able to further relax these restrictions on share capital withdrawals, and at the current time members are able to withdraw up to a maximum of £25,000 per calendar year, up from what we reported in October of 20,000, with all withdrawals being subject to a 90-day notice period still. So turning to the numbers, to summarise the performance in the last financial year at sector level first. The food business, excluding fuel and bill payments and lottery sales, recorded a decrease in gross takings of 1% compared to the previous year. That performance was impacted heavily by the cost of living crisis, with the volume of product that we sell decreasing by 7.9%, as consumers managed their finances by buying less, a trend that has been seen across the food retail market. In order to attract more customers into our stores and attempt to mitigate the volume decreases from the existing customers, we have focused very much on increasing the services available in our stores. We've introduced every parcel services, Amazon lockers, an improved coffee to go offer under the Pret brand, and more recently, InPost lockers. All of these have taken off well since their introduction, and we continue to look for further opportunities to drive footfall to our stores. This is under a campaign which we're calling More Than Just a Shop. We've spoken on many occasions about creating a community hub in our stores. Our stores are not just for buying the groceries, they're fulfilling any need you may need in the community, from you paying your bills, your lottery tickets, supporting the community, as Kevin will describe later, and trying to get that footfall increased in a local area and giving people a reason to turn left into the Co-op rather than right into a competitor. And it's our view that the more of these add-on services, the more reasons people have got to turn left rather than right. Trading profitability in the food business unfortunately fell year on year by 55% compared to the previous year. That's been heavily impacted by not only the volume decrease, but by substantial operating cost increases and the fact that trading was strong in the first half of 2021 due to lockdown up until 11th of April, I think it was, in 2021, which gave us high comparatives, and also the closure of hospitality for around half of 2021. Gross takings in our department store business grew year on year by 37%, with turnover recovering after the pandemic years, but failing to recover to above pre-pandemic levels as customers battled with the cost of living. Trading losses in the department stores continue. They represented 2.14% of net sales, an improvement over the 6.87% in the year ending January 2022. The performance of the department stores continues to be of concern to the board and the management team. Both the board and the management team continue to explore all the opportunities to reduce the operating losses from department stores to ensure that the society's profitability is not undermined by this area of the society's retail offer. Our travel business rebounded following the pandemic, recording an increase in gross takings of 280% compared to the previous year, as a result of international travel restrictions being lifted and people returning to their previous holidaying habits. As a result of this increase in gross takings, the travel business returned to profitability in the year, generating a trading profit of £120,000 compared to a £94,000 loss in the previous year. In our funeral business, gross takings increased in the full year by 6%. In May, we opened our 9th funeral home with our Basildon branch opening. This represents a new trading area for the society. While it's taken longer than expected to build the business in Basildon, work continues to ensure this branch is a success in the medium term. Full year profitability of the funeral business fell 13.22% year on year, representing the additional costs of the new branch and in the increased operating cost base, such as energy and fuel. Finally, our rental income from our investment property portfolio decreased by 13.3% year on year. Looking now at the high level performance for the society, gross takings, as the Vice President has already detailed, totalled 106,184,000 in the year. That was an increase over the previous year of 6,692,000, or 6.73%, reflecting far more normal trading patterns than we'd seen over the previous 2 years. As members can see from the slide, the society is still operating below the pre-pandemic years of 2019 and 20 and 2018 and 19. This is due to several factors, including the fall in volume in food stores, already touched on, as consumers try and make their disposable income go further. We lost, during the pandemic, a key concession partner in department stores, Arcadia, which was well-known brands I think everybody was familiar with, and there are no brands of that strength out there at the moment looking to move into concession operations. Also, the drop in sales of big ticket items in department stores, such as furniture and carpets, and also a slower recovery in travel than we expected. So although profitability in travel rebounded really well, it was still below where we would have seen it pre-pandemic. Turning now to our gross profit, our income. Income increased by 5% year on year, reflecting the improvement in the management of gross margin across the business as we've grappled with passing on manufacturers' costs as far as we can without becoming too uncompetitive, and the fact that department stores also traded for the full year compared to only 40 weeks back in 21-22 because of the lockdown at the beginning of that year. Operating costs is where it starts to get interesting. Operating cost is where the wider economic turmoil really shows in the accounts, with operating costs increasing year on year by 1,429,000, or 6.21%. I think it's worth taking some time to explain that number and where those underlying increases are from. During the pandemic, the society received assistance from central government in the form of business rates relief, as many retailers did, as all retailers did. This support came to an end during 2022, which resulted in a year-on-year increase in our business rates back up to normal levels, and that increase totalled £396,000. Second area, as members will know from their own domestic energy bills, the cost of gas and electricity increased massively during the year. The society spent an additional £695,000 on utilities during the last year. The cost of distribution, so this is the amount that we pay to the co-operative group for having goods delivered into our stores, increased by £161,000 in the year. That's despite us selling 7% less product. So we're paying more to the group for distribution for less product being delivered into our stores. That's the result of several factors: increased cost of fuel, increased cost of energy to run the warehouses, and their labour costs. And I think certainly back in the end of 2021, the dispute between drivers, warehouse workers and employers was well covered by the media in terms of the wage increases that they are asking. The biggest issue, though, in terms of the increased distribution cost is a drop in volume. So we've reported a 7% drop on volume. That is representative of the movement. So around 7% less cases are going through warehouses, and that results in the case cost going up. Those three areas accounted for 88% of our year-on-year increase in operating costs. A further £246,000 of the increase was driven by increased labour costs of the Society's own, and this is a trend that's set to continue with the large increases being seen in the National Living Wage each April. Combined, the four areas accounted for a year-on-year increase of 1,498,000, a level in excess of the year-on-year increase in total operating costs. So given that most suppliers are passing on their increases in labour, so for example refuse collections, their costs have gone up because of fuel, because of labour. Any maintenance services, those costs are going up by at least inflation. What it does show is the Society has done a very good job of controlling the underlying operating costs to protect overall Society profitability. Turning now to operating profit, trading profit before other operating income totalled £65,000. That's a reduction of 86.8% on last year. And a performance given the headwinds, which, in my opinion, is reasonable. And all the indications are that other cooperatives are reporting drops in profitability. Our task now is to begin to rebuild profitability as inflation begins to slow. But the size of the challenge should not be underestimated, as consumers will continue to experience a real-term drop in disposable income, as wage rises are set to continue to be below inflation. And I think you can see that in the media with the activity around strikes, government's stance on the public workers, etc. So it's unlikely that we are going to see any improvement in the short term of consumers' disposable income. Members will note that in the revenue account we're showing investment income of £183,000. This reflects a revaluation of our investment property, which we hadn't revalued for several years because of the uncertain property market driven by the pandemic. The exceptional income and charges shown relate to the impairment of goodwill amortisation and accelerated depreciation of some of our loss-making stores. Note 3 in the accounts lists all of these items should you wish to examine them in detail. At the retained profit level, the Society made a profit of £7,000. Clearly a disappointing position compared to last year, but respectable given the challenges that we've outlined and we faced during the year. Net debt, touched on by the Vice President in his opening address. The annual accounts show that at the end of January 2023, the Society had debt totalling £166,000. Following a year due to the central government financial assistance and low capital expenditure due to the lockdowns, we were showing no debt on paper. As you can see on the slide there, we were showing actually £886,000 to the good. With trading continuing to be tough, it will continue to be important for us to ensure that any capital expenditure projects we do are directed towards the right areas and areas that will produce the largest return for the Society. So that is an overview of the annual accounts. Obviously, the accounts in front of you give more detail, certainly in the notes section. I'm happy to take any questions if members have got anything they want to raise about the accounts. I've just got a microphone for you, sir.
Yeah, you mentioned the way in which the co-ops, food stores, are actually trying to meet needs of the customers. in a far greater sort of way than what you've done before. And I just wondered, in the case of the Morsham Lodge food store and with the post office shutting on Morsham Lodge, whether there were any plans to take in the post office at the Morsham Lodge food store. I mean, maybe you can answer it, maybe you can't.
I can answer that. I can answer that in detail. We were approached,
you.
as you would expect, by numerous bodies, including the local MP and a local councillor, about taking the post office into the store. We conducted a full review of looking at that. Bottom line was we could take it, but it would cost us money to run it. So I went back to the post office and said, look, we're prepared to do it, but we will only do it on this basis, which means we can't trade it the hours you want us to do. The post office wouldn't really budge. They said, yeah, we'll let you drop the hours a little bit. And I said, well, okay, fine, but we need to go further than that. They wouldn't go down to the level we felt would be sustainable for us, and the level of money we'd need to invest in setting it up, they wouldn't move on that either. So unfortunately, we had to say no. So, but yeah, rest assured, we did look at it in a lot of detail before we said no. Okay. Okay, if there's no further questions, we're now a quarter of the way through the new financial year. So it seems like the ideal time to give members an update on how we've started the year. I spoke just now about the cost of living crisis, and it is still very real. And obviously there is no sign yet that it's going to let up anytime soon. So this is very difficult for us to grow turnover in real terms when consumers are scaling back, not just on that discretionary spend, you know, fashions, furniture, carpets, etc., but also on their food and drink spend. The Society's gross takings in the first 13 weeks of the year have increased by 3.3% year on year. And that growth is being driven by fuel, food, funerals and the investment property business. There's clearly in the food and fuel inflationary elements, which we'll cover in a minute. The core food business, so that's everything excluding our paper win and lottery, which are purely services which we collect on other people's behalf. That core business is increased by 4.3% compared to last year. Now that's driven by food price inflation. So I think the latest figure I've seen for food price inflation is about 17%. So when you look at that, it's quite clear that our volume continues to be down year on year, quite substantially. And that's a problem not only that we're having, the industry in general is having, unless you're a discounter, and certainly the co-op movement is performing at the same level as we are. So it is a movement-wide problem, definitely. The services element of our food business was down 5% year on year, and that reflects, it's grown 5% year on year, and that's obviously reflecting to a degree the continued inflation in energy prices. Fuel turnover is 2.3% higher than last year, and that's being increased by the volume of fuel being sold rather than purely inflation. And I think you'll see recently fuel prices dropped a little bit more, but we are driving volume in our fuel business, which is encouraging. The department store business is trading down year on year by 4.9%. That's a mix of a 10.8% decrease in our own bought and a 5.5% increase in the concession business. Own bought business is suffering in the main for two areas. Furniture, as you'd expect, being large value purchases, and also ladies' fashions, not helped at the moment by the cooler weather, shall we say, for the time of year. Travel business is struggling at the beginning of this year. We have got an 8.2% decrease, which is a lot lower than we were expecting. We've been, until recently, severely understaffed in the business. There was a lot of individuals that left the travel business during the pandemic through no choice of their own, being obviously either laid off or furloughed. there are very few of those now looking to re-enter the travel market. I think it's a case of, they've lost their jobs in an industry they knew well once, they're not going to risk it again. So trying to recruit where we've left staff, as they've left to pursue other avenues, we are struggling. But we are managing to recruit some colleagues in the last few weeks, and hopefully we'll be back to normal trading and be able to report better figures at the end of the year. As a result, gross takings in travel down 8.2% year on year, and that's being made up of both the bookings and also foreign exchange recording decreases. Funeral business is showing growth of 8.1% against year on year. That's not only an inflationary increase, the number of funerals that we've conducted are also up year on year. And finally, our investment property portfolio has generated an increase of 31.9% in gross takings compared to last year, and we now have a situation where all of our commercial property has tenants in situ. I think it's clear at the end of the first quarter that the year will continue to present us with challenges. Brendan Smith, Chief Operating Officer, will now take you through some of the business's developments that have been conducted both in the last year and are planned for this year to try and counteract those challenges that we're seeing.